was solid for the year overall. Following weakness in the middle of last year, activity in the housing sector seems to have stabilized. In the labor market, conditions remain solid and appear to have stabilized. Payroll job gains averaged 189,000 per month over the past 4 months. Following earlier increases, the unemployment rate has been steady now since the middle of last year, and at 4% in January remains low. Nominal wage growth has eased over the past year, and the jobs to workers gap has narrowed. Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance. The labor market is not a source of significant inflationary pressures. The strong labor market conditions in recent years have helped narrow long-standing disparities in employment and earnings across demographic groups. Inflation has eased significantly over the past 2 years, but remains somewhat elevated relative to our 2% longer-term goal. PCE prices rose 2.6% over the 12 months ending in December, and excluding the volatile food and energy categories, core PCE prices rose 2.8%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. Since last September, the FOMC lowered the policy rate by a full percentage point from its peak, after having maintained the target range for the federal funds rate at 5.25% to 5.5% for 14 months. That recalibration of our policy stance was appropriate in light of the progress on inflation and the cooling in the labor market. Meanwhile, we've continued to reduce our securities holdings. With our policy stance now significantly less restrictive than it had been, and the economy remaining strong, we do not need to be in a hurry to adjust our policy stance. We know that reducing policy restraint too fast or too much could hinder progress on inflation. At the same time, reducing policy restraint too slowly or too little could unduly weaken economic activity and employment.
Chris, I just shot you a message on Discord.
In considering the extent and timing of additional adjustments to the target range for the federal funds rate, the FOMC will assess incoming data, the evolving outlook, and the balance of risks. As the economy evolves, we will adjust our policy stance in a manner that best promotes our maximum employment and price stability goals. If the economy remains strong and inflation does not continue to move sustainably toward 2%, we can maintain policy restraint for longer. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we can ease policy accordingly. We are attentive to the risks on both sides of our dual mandate, and policy is well positioned to deal with the risks and uncertainties that we face. This year, we are conducting the second periodic review of our monetary policy strategy, tools, and communications, the framework used to pursue our congressionally mandated assigned goals of maximum employment and stable prices. The focus of this review is on the FOMC's Statement on Longer Run Goals and Monetary Policy Strategy, which articulates the committee's approach to monetary policy, and on the committee's policy communication tools. The committee's 2% longer run inflation goal will be retained and will not be a focus of the review. Our review will include outreach and public events involving a wide range of parties, including Fed Listens events around the country and a research conference in May. We will take on board lessons of the past 5 years and adapt our approach where appropriate to best serve the American people to whom we are accountable. We intend to wrap up the review by late summer. Let me conclude by emphasizing that at the Fed, we'll do everything we can to achieve our dual mandate goals that Congress has set for monetary policy. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. Thank you. I look forward to your questions.
Thank you, Chairman Powell. Certainly your words and your actions have a global impact. You have the opportunity and responsibility of leading this country in the right direction economically. And I thank you for your commitment to having a conversation with all of us about how you do that well. You and I had a conversation yesterday. Some of it was frustrating, some of it was illuminating. But in the end, my goal is to make sure that the American people, and specifically those working paycheck to paycheck, have more opportunities to succeed, not fewer. You have said that the Fed is not against innovation, and banks are perfectly able to serve crypto customers as long as they understand and can manage the risks. Yet you have admitted that the threshold has been a little higher for banks engaging in crypto activities. Last week, I held a hearing on debanking and once again heard that federal banking agencies, in particular the Fed, use reputational risk as a tool to encourage the debanking of certain legal industries and law-abiding citizens for political reasons not tied to safety and soundness. Debanking is a top priority for this committee, and it certainly is for me, and one that I believe is a bipartisan issue. Will you commit to working with this committee to end debanking, including working with the new Vice Chair of Supervision, once appointed, to revise the Federal Reserve supervision manuals to remove reputational risk as a tool to weigh in on political topics?
I'm happy to make that commitment.
Thank you, sir. Accountability is very important. I would like to think accountability is a priority for everyone, especially the Fed, given that failures in Fed supervision can result in the loss of billions of dollars. Yet following the failure of the Silicon Valley Bank, which was in part due to the failures of its regulators to identify egregious mismanagement of interest rate and liquidity risks, we have yet to see any regulators be held accountable. And as you recall, that was a point of my frustration. As a guy who's spent a lot of time in the private sector, 15 years running a few businesses, I can tell you that accountability is a necessary part of making the entire organization healthier and perform its job as well as possible. I'm encouraged that the FDIC has begun the process of holding SVB executives accountable. That's good news. But no Fed employee has been fired, put on probation, put on performance improvement plan, all of which would be expected in the private sector, as I just mentioned, for employee failure. Please explain to me why Fed employees are held to a different standard from my perspective than everyone else, and what are you planning to do to take accountability for Fed failures in supervision?
So we've actually done quite a lot in response to the events associated with Silicon Valley Bank. So we've done many, many things. In terms of specific accountability, what we found was this was not a case of malfeasance or nonfeasance so much. It was a case of people were carrying out a specific playbook that failed to cause us to act in time for these things. So it wasn't actually particularly fair to the employees to say you violated our practices in some way. That wasn't really what happened. What happened was, I would say, a lot of focus on process and on governance and controls, and not enough focus on basic bread and butter banking, credit risk, liquidity risk, interest rate risk, things like that. So as we discussed yesterday, we took very substantial steps to avoid further spread of those issues, and that was successful. But I understand your point on accountability.
This is one of the areas where you see the approach to looking at safety and soundness, and with the number of MRAs and MRAs that when really documented but no action was taken, that leads me to the conclusion that individual employees, supervisors should have been held account for that. I'll move on though. In the past, you've supported tailoring regulations so that we ensure banks of different sizes thrive and to preserve our diverse banking system. Will you commit to working with me as chairman to make sure that financial regulations do not impose more burden than is necessary? I'll say that this comes after a number of conversations with community banks and regional banks that have continued to stress that the cost of the regulatory framework around them isn't just harsh, it's oppressive. Larger banks suggest that the cost per employee for the regulatory framework is $10,000 per employee. I think we can do better, and would love to hear your thoughts on that.
Right. First of all, I will commit to working with you on that. We do try to avoid excessive burden. I think it's fair to take a fresh look frankly, on debanking. I think we all see, both in your hearing and in the one on the House side, we hear a lot of people talking about that. And, it's time to take a fresh look, I think. We don't intentionally do these things, but sometimes regulation leads things to happen, and we need to be working on that.
I appreciate that. And I'll turn over to the ranking member. I'll say this. After having a number of conversations with CEOs of banks around the country, one of the things that was made clear to me with specific statement from these CEOs is that the regulatory OCC and other regulatory agencies said specifically to debank certain industries. And that is the point that I'm making, and one that I think we have to solve. If it's legal in America to do business, we should do our part to make sure that they're banked.
Thank you, Mr. Chairman. So over the weekend, Co-President Musk and Acting Director Vogt effectively shut down the CFPB. No more cop on the beat looking out for a family of 4 in South Carolina facing an illegal foreclosure. No more cop on the beat looking out for your grandma whose bank account has just been taken over by a scammer. No more cop on the beat looking out for people getting ripped off by giant credit card companies that are charging illegal junk fees. It also means that the CFPB is no longer doing one of its most important jobs, examining big banks to root out illegal conduct before it happens, or at least stop it before more people get hurt. Chair Powell, if the CFPB isn't on the job right now, then who is administering JP Morgan or Wells Fargo's consumer compliance exams to ensure that they are following the law?
Senator, I believe that, and you would know, that Dodd-Frank moved all authority for examinations in the consumer space to the CFPB. We still have some jurisdiction.
We'll talk about that in a sec. But the answer to my question, please. If the CFPB is not there examining these giant banks to make sure they are following the laws on not cheating consumers, who is doing that job?
I can say no other federal regulator.
No one, in other words. So thanks to Co-President Musk and CFPB Acting Director Vogt, Wall Street banks no longer have to show the bank examiners that they're not illegally opening accounts people didn't ask for, like happened with Wells Fargo, or charging illegal junk fees like the Bank of America did. But CFPB has jurisdiction only on banks that have more than $10 billion in assets. So what's happening in thousands of community banks all around the country, those that have less than $10 billion in assets? So Chair Powell, as you know, the Fed oversees consumer compliance for state member banks that have less than $10 billion in assets. Has the Fed suspended consumer compliance exams for those smaller banks, or is the Fed still on the job to make sure that those smaller banks are following consumer financial laws?
Still on the job, business as usual.
All right. By forcing the CFPB not to do its job, President Trump, Elon Musk, and the author of Project 2025, Russ Vought, are giving Wall Street banks an unlimited get-out-of-jail-free card so they can cheat working families, even while community banks continue to play by the rules. You know, for any Americans who have money deposited at JP Morgan or Wells Fargo or any other of the giant banks, they should now know that there is no one on the job to make sure that those banks are not scamming you. Only the smaller banks now have a cop on the beat to make sure that they aren't cheating consumers. You know, if I have my money in one of those giant banks, I might think about going to a smaller bank where the protection, at least right now, is a whole lot better. Now, at the same time that the CFPB is under attack, the Fed is buckling to pressure from Wall Street to erase other safeguards for the too big to fail banks. During the first Trump administration, under your leadership, the Fed weakened the big bank stress tests, including by giving the big banks some of the answers to the test in advance. I called you out on it, but you promised right here in this committee that you would not give those banks the whole answer key. I'm going to quote you back. You said, Complete knowledge of the models could lead to a model monoculture in which all firms have similar internal stress testing models, which could increase the correlation of risk in the system and miss key idiosyncratic risks faced by the firms. I agreed with you. But several weeks ago, the Fed announced that it has plans to do exactly that, hand all of the answers over to the giant banks. Chair Powell, why is the Fed about to propose a rule that directly contradicts your own testimony and in your own words would render the stress tests toothless?
Senator, in essence, because the ground has shifted very substantially in administrative law, and we actually want the stress test to remain resilient to that. And so we're making changes to accomplish that.
Well, the changes are changes you've identified earlier as making those tests toothless. Look, the big banks are going to juice shareholder payouts and leave this economy more vulnerable to a crash. The Fed is knuckling under to bank lobbyists. We know how this ends. People will suffer. Wall Street will get bailed out. I urge you, Chair Powell, to serve Main Street instead of Wall Street. Don't weaken these rules.
Thank you. Senator Rounds.
Thank you, Mr. Chairman. And Mr. Chairman, thank you for coming before the committee. I appreciate the opportunity to visit with you. I've got a series of questions, but I would like to give you an opportunity, if you would like. The suggestion that the ranking member has made here is that the big banks can now scam individuals right now. Any change in the laws regarding how they're supposed to be treating the individual consumers out there or anything along that line?
Law changes? No, I'm not aware of any
Any
law
changes, any rules that they would have to follow?
Not that I'm aware of.
Are they still audited, and do they still have the regulators in watching all of their businesses just as they did before?
Well, they'd have all the regulators except for the CFPB.
Very good.
If in fact, in the hypothetical, the CFPB weren't carrying that out.
Anything else you'd like to add before we move on?
No, I'm good. Thank you.
Thank you, Mr. Chairman. As we continue to prioritize the stability and the resilience of our financial system, the ongoing Basel III rulemaking process has remained front and center in shaping our regulatory framework. Now, I guess I was rather outspoken with my opposition to the original proposal, and further work was stalled at the end of the last year. I guess my question for you today, sir, is could you provide an update on the Federal Reserve's progress in finalizing the Basel III endgame rulemaking process?
I'd be glad to. So we remain committed to completing Basel III endgame. We think it's good for U.S. banks. It's good for our economy that there be a global standard beneath which foreign banks can't fall. And that was one of the big ideas behind the whole Basel committee approach. So where it sits now is we await leadership arriving at the OCC and the FDIC, and that seems to be happening. And when that happens, we're going to sit down with them and work our way through to a Basel III endgame proposal. And I think we can do this reasonably quickly, one that is compliant, consistent with the Basel requirements, and also consistent with what other large jurisdictions are doing. I'm optimistic that we can do that fairly quickly, and we're committed to doing that.
We always wanted our banks to be competitive with European banks. And I'm just curious, the original proposal that was in front of you, and I'd like your thoughts on this, it was estimated to increase our bank's capital by 19%, which I think may very well have created a potential disadvantage within the U.S. institutions versus our European counterparts. With any new proposal, what's your thoughts? Would you make a commitment that this would be a neutral approach with regard to capital?
The main commitment I'll make is we'll work together with new leadership at the other banking agencies to do something. But that's certainly, I've said many times in this committee that I think that the level of capital in the largest banks is about right, and so it'll shake out somewhere in that area. I would guess. Our
expectation would be, and the markets would expect that it would be neutral with regard to capital
in that range. But I want to defer to our new colleagues and get their views as well. But that's a good starting place.
Okay, thank you. The Federal Reserve's partnership with the U.S. Treasury plays a central role in supporting our nation's payment infrastructure, which processes a vast range of daily transactions, from federal benefit disbursements to debt obligations. Could you outline the Federal Reserve's role in supporting and managing the Treasury's payment systems, including how the Fed works to keep these systems secure, efficient, and capable of handling the government's high volume of daily transactions?
So it's a complicated set of arrangements, and I'll try to summarize quickly. Effectively, Congress authorized spending, and then the agencies carry out those spending orders. And when the way they do that is they send an order to pay a payee, a recipient, to the Treasury Department. Upstream, before it gets to the Fed, all of these decisions are made about, is this an appropriate order? Is this payee on the don't pay list, and all those things. Once all of that is set, it comes to the Fed, and by that I mean 4 or so of the reserve banks, and we actually make the payment. We take the money out of the Treasury General account and we make the payment. We make no judgments whatsoever. Those are all made upstream from us, and we are in fact the fiscal agent of the Treasury.
Confirm for me today, is the system safe today?
I believe it is, and I will tell you, we are very strongly committed to the integrity, efficacy, resilience, and all those things of this system. And people do depend on this in a big way, and we're committed to that.
One last question for you, sir. The failure of Silicon Valley Bank, and the chairman brought this up. I'm just curious, recognizing a lot of banks out there looked at this, it cost the other banks in the system a lot of money to pick up the costs involved in the losses. Nobody's been fired, but you did indicate that it was a failure in the playbook. Has the playbook been revised, or can we expect that it will be revised?
In a lot of ways, it's been revised. Yes, I can go into some details. I mean, one thing that didn't happen was, for example, the supervisors didn't follow through aggressively enough on things that they'd said. If they'd done that could well have been enough to stop it. Yeah, but a lot of it was just not focusing enough directly on what was a very large amount of interest rate risk, a large portfolio of long-term securities matched up with an unstable funding base. And somehow people wrote about that, and not the Fed, but others wrote publicly about this, but somehow we don't expect bank runs outside of a crisis in this country. And that's what that was. It was a bank run, and bank runs are incredibly damaging. I think everyone learned a lot from that and is determined to do better.
Thank you, Mr. Chairman. I think this is one that I think, as you appropriately pointed out, I think this is an area where a lot more questions are out there yet. And I think if it's the playbook that was the problem, I think perhaps a discussion about how that playbook has been revised would be appropriate in the future. Thank you, Mr. Chairman.
Thank you. Senator Cortez Masto.
Chairman Powell, thank you. And thank you always for the conversations in between these hearings as well. Let me focus on a couple of things of concern. And you touched on a little bit of this, and I think this is important to clarify. There was a change in the law when the CFPB was created. The CFPB examines the banks and enforces the law, whereas the Fed only supervises those banks. Is that correct? Or how would you determine that relationship?
With the CFPB? So Dodd-Frank took a lot of the consumer compliance jurisdiction away from the other banking agencies and gave it to a newly created agency, the CFPB. We retained a residual amount of that, as we just discussed, which was banks under 10 billion in assets. But the CFPB essentially took all of that when Dodd-Frank came into being.
So as it was created, when you two were working together, the Federal Reserve collaborated with the Consumer Bureau when supervising those large banks, correct?
Yes, we still retain supervision over all the holding companies and also of Fed member banks.
And let me ask you this then, does the Federal Reserve enforce consumer protection laws now for things like money transmitters?
Not for money.
That would be the consumer protection. That would be CFPB.
Yes, yes.
Okay.
That's
And
right.
so when we're talking about collaborating with the CFPB for financial technology firms, what would the Fed Reserve now do that if the CFPB, if the hypothetical is the CFPB no longer exists, what would be the Fed's role right now with respect to technology firms?
We don't have jurisdiction over, we have jurisdiction over banks and some financial
that's it.
market utilities.
So let me ask you this, because I know there's a number of Nevadans who file consumer reports of concerns about fraud and predators with the CFPB. The Fed Reserve doesn't receive those reports, correct?
No, I don't believe
And
so.
you have no role when it comes to consumer protection like the CFPB does, correct?
Unless you're a Fed member bank that has 10 billion or less in assets, then we have jurisdiction.
Right.
On a
So there is
consumer.
a gap. If the hypothetical is true and what we're hearing that the CFPB is being shut down, there is a gap, what we're hearing in enforcement out there, and particularly when it comes to consumer protection. Is that, would you say that's true?
Yes, for all banks that we don't
Yeah.
supervise.
And I think that's the concern we're all having right now, is this concern of when we're looking to streamline government. And listen, I'll be the first to tell you, there's a lot of bloat. We need to streamline it. We need to address regulations and overreach. But there's a strategic way to do it, and not this burn down the house that is going to harm people across the country, including in my state, those Nevadans that are looking for some sort of enforcement around consumer protection law. So that's what you're hearing from many of us on our side of the aisle here.
Can I just very briefly add that we do have some residual enforcement authorities, but what we don't have is examination authority. And for the banks that the CFPB supervises.
Thank you. Let me ask you this, and we talked about this over the phone, and I understand it may be difficult to answer this, but the Federal Reserve Board members have been clear that future interest rate cuts are unlikely to happen despite the strong economy. But there are folks in my home that are in my state that are waiting to buy a home. And we know that's still an issue, the high prices right now for home affordability. You add the interest rates to it, it is a problem. So do you think it's most likely that interest rates will remain above 6% for this year, or can you even address that?
So overall, the economy is strong, growing 2.5% last year. The labor market is also very solid. Unemployment at 4%, quite a low level. Inflation last year was 2.6% for the year. So we're in a pretty good place with this economy. We want to make more progress on inflation, and we think our policy rate is in a good place, and we don't see any reason to be in a hurry to reduce it further. As it relates to housing, so it's true that mortgage rates have remained high, but that's not so directly related to the Fed's rate. It's really related more to long-term bond rates, particularly the Treasury, the 10-year Treasury, 30-year Treasury, for example. And those are high for reasons not particularly closely related to Fed policy. They may remain high. I think, once we lower rates and kind of rates return to a lower level, mortgage rates will come down. I don't know when that'll happen. And even when it does happen, we're still going to have a housing shortage in many places.
Thank you. Chairman Powell, thank you again for being here.
Thank you, ma'am. Next will be Senator Kennedy.
Thank you, Mr. Chairman. Thank you, Mr. Chairman, for being here.
Okay. Yes, ma'am.
My friend, our ranking member, said that you are knuckling under to the big bank lobbyists. Is that true?
No.
It seems to me that the big picture should not go unnoticed. Do you recall a year or two ago when inflation was raging? I think its peak was about 9%. Many economists and other experts, based in part on history, said that you were going to have to provoke high unemployment and put our country into recession in order to get inflation down. Do you recall that?
Very, very well.
Are we in a recession?
We are not.
Would you, as an American, trade places right now with Germany in terms of the economy?
No, I sure wouldn't.
How about China?
No, wouldn't trade places.
How about France?
No, thanks.
Things aren't perfect. Inflation's obviously still sticky, and long rates are too high, which I want to talk about in a second. But the fact is, knock on wood, we have experienced a soft landing, haven't we?
Not for me to say, really. I'll let others
Well, have
make
we
that.
experienced a hard landing?
No, we sure
Are
haven't.
we in a recession?
No, we're not.
I call that a soft landing. And it seems to me that you and some of the ladies and gentlemen who are your colleagues at the Federal Reserve behind you deserve some credit for that.
Thank you.
I don't know why you don't take the credit. Everybody else in Washington, D.C. does. Again, I'm not saying things are perfect, but I never imagined that our landing could be this soft, albeit not perfect. And I wanted to thank you and your colleagues for that effort. You sure didn't get any help from Congress and on the and our president on the fiscal side. I don't expect you to comment on that. You and the Federal Reserve can to a large extent control short rates, can't you?
Yes.
Through the open market committee. You can't control long rates though, can you?
No, we can't.
Why is that?
So a lot of things go into long rates, and one of them is the expected future short rate of Fed policy, but many other things go in. Expectations of inflation in the longer run, the sort of risks around the economy and around the budget deficit go into something called the term premium, which is the part we can't explain when we do these decompositions. And so, it's set by supply and demand in the bond market at the long end, and we're not particularly. We have some influence, but mostly not.
Many Americans are looking at short rates and looking at the Fed's behavior and how you reduce inflation, but they don't see the long rates going down, and obviously that affects mortgage rates. And I would encourage you and your colleagues to spend some time explaining to the American people why that is. Final question. If you went home tonight and Mayor Powell, your spouse, said, I got a call today from our bank, and they're debanking us. They're worried about their reputational risk because they don't like our politics. Would you think that fair?
No, I sure wouldn't. And as I mentioned earlier, I too am troubled by the quantity of these reports, and really want to understand better why this is happening. One theory is that banks are just very risk averse around BSA and money laundering, and that's because we're so tough on them, and that they just don't. Any red flag is enough. But it may be that this whole thing with reputation risk needs to be thought about. It's actually coming out of our one manual that we use. We're taking that concept out, the manual that we've been using for account access for master accounts. We're just going to take that out. But I think this needs a fresh look, and I think it's time for that, and we're going to do that.
Well, I've asked our chairman, and he has agreed to invite some of the CEOs of some of the banks that have been debanking people. The CEOs,
Yes.
not their lawyers, not their PR consultants,
Not the lobbyists.
not their priests, them, the CEOs, to come in and let's talk about this and find out what the hell's been going on.
Thank you, Senator Kennedy.
Thank you, Mr. Chairman.
Senator Reed.
Thank you, Chairman Scott. Chairman Powell, welcome. Thank you very much. I think your monetary policy combined with the Biden fiscal policy over the last 4 years has made a tremendous difference. We've avoided a recession. And I'd like to remind people how far we've come. In 2020, the gross domestic product decreased 2.2%. The unemployment rate finished the year at 6.7%. By 2024, gross domestic product grew 2.5%. The unemployment rate was 4.1%. Labor force participation rate went up from 61% to 62.5%. And that's a combination of your work together with the fiscal policy of the Biden administration. So I thank you for that. One of the issues before us today is the issue of tariffs. In July 2018 testimony, you stated, Mr. Chairman, countries that have remained open to trade, that have not erected barriers, including tariffs, have grown faster and had higher incomes. Do you still believe that?
Yes, I do. I would stand by that.
So President Trump's tariffs on China, Canada, and Mexico will obviously raise costs on families. In fact, some economists, many economists, project about $1,200 per year households will be paying extra, an increase of inflation by nearly 1%, economic growth depression, and, for example, the increase of the average car price by $2,700. Is that a wise policy?
So I guess I ought to say this. I think the standard case for free trade and all that logically still makes sense. It didn't work that well when we have one very large country that doesn't really play by the rules. And in any case, it's not the Fed's job to make or comment on tariff policy. We, really, that's for elected people, and it's not for us to comment. Ours is to try to react to it in a thoughtful, sensible way and make monetary policy so that we can achieve our mandate.
Just this weekend, the president removed the board of the Kennedy Center and made himself chairman. What would you do if the president tried to remove a member of the Federal Reserve Board?
Well, it's pretty clearly not allowed under the law.
Thank you. We've communicated back and forth about synthetic risk transfer as a potential danger to the banking system. And could you give us some insights on how we can improve financial stability by regulating these transactions more appropriately?
What we've been doing for some time now is looking at them on a case-by-case basis. And if they really do transfer risk successfully, then that's okay. I mean, it's a good thing if a bank wants to transfer risk off its balance sheet in a way that it gets compensated for and all that. But what you want to make sure is that the risk is really transferred. And that was the problem during the global financial crisis, was sort of things that appeared to but did not accomplish a transfer of risk. So we see this coming, and we've been looking at these transactions on an ongoing basis.
Well, I commend you for that. In fact, what happens typically is the transaction becomes complicated by synthetic risk transfers, as it was the case with synthetic derivatives. So thank you for your attention to that. We've talked about housing. It's absolutely critical everywhere across the country. We're in a housing shortage. Of course, while housing is difficult, two of the mainstays of our housing market are Fannie Mae and Freddie Mac, helping to support home ownership. Does the federal guarantee backing Fannie and Freddie help make mortgage rates more affordable and home ownership more accessible, Mr. Chairman?
I imagine it does hold down mortgage rates, the fact that they're a sovereign risk.
And how important is the 30-year mortgage to ensure that families can afford a home?
In our housing market, the 30-year mortgage is very important.
Yeah. And I have heard some discussions about eliminating Fannie Mae and Freddie Mac, which would be detrimental, I presume, to the housing market.
That's really a question for you. I mean, putting them back in the private, putting housing finance back in the private sector has some appeal over the longer run, but I leave that with you.
Thank you, Mr. Chairman, very much. Appreciate it.
Thank you, Senator Ricketts.
Well, thank you, Mr. Chairman and Ranking Member, for holding this important hearing. And thank you, Chairman Powell, for being here today to talk about our economy and all the things that are going on. I want to address, again, something that the ranking member started talking off about, which was characterizing the CFPB as being the cop on the beat here. But I can tell you, as having been a governor and having a Department of Banking that reported to me, that if any consumer would contact us and make a complaint about a bank, even a big bank like JP Morgan, we would investigate, as could the OCC, the FDIC, the FTC. So to characterize that nobody's out there looking for consumers, I think is inaccurate. And we ought not to try and scare consumers right now that somehow this is the case, because if you do have an issue, if you're a consumer, please reach out to your state Department of Banking, because those folks are going to look out for you. I can tell you that because I used to have one of those Department of Bankings. They did a fantastic job of looking out for the consumers. One of the things that has also impacted consumers is inflation. Prices under the Biden inflation were up 20%. An average household is paying $13,000 more today than they were for the same standard of living they had before Joe Biden got elected. We see that grocery prices, for example, are up 22%, rents up 23%. Simply put, Nebraskans are economically worse off today than they were 4 years ago, and I expect that that's part of the reason why we saw this change in the administration. They thought that that was not something that they wanted to continue to pursue. They didn't want the same policies being followed. We have to end the reckless federal spending, rein in inflation, and be responsible about how we make decisions to be able to grow the economy. One of those areas that I'm concerned about is the expansion of the Fed balance sheet. The Fed's balance sheet before, at the end of 2019, so before the pandemic, was about $4.1 trillion. By May of 2020, the Fed expanded that to $7 trillion. And by 2022, the Fed's balance sheet hit an all-time record of $8.9 trillion. Inflation peaked at 9.1% that year, a high we had not seen since 1981. Now, I'm encouraged by the actions the Fed has taken with quantitative tightening down to $6.85 trillion, but $6.85 trillion is still too high. And one of my concerns with the chairman is that that's kind of one of your tools to be able to guard against a downturn in the economy or some sort of shock. Obviously, you used it during the pandemic. Looking ahead long term, will the Fed Reserve continue to this course of unwinding the balance sheet?
Yes. So what we said is that we intend to slow and then stop the decline when reserve balances are somewhat above the level that we judge consistent with so-called ample reserves. The most recent data and the feel of the markets is definitely that reserves are still abundant. They're about the level they were at when runoff started, because the runoff has really happened out of the overnight repo facility, reverse repo. So yes, it's an ongoing thing, and we're not yet where we're headed.
So what kind of pace can we expect? And I know that obviously there's going to be a lot of factors like what happens to the economy over the course of next year. But if things were going to go along the way they are today, you've already said the economy's doing well. Inflation's a little higher than we want it to be at 2.6%, but unemployment's at 4%. If these commissions, and I think you used the word stable quite a bit, if these conditions were to remain stable throughout the course of the year, would you have a range that you could give us of where the balance sheet might be if we were talking again here in January 2026?
We basically, we're going to be looking at reserve conditions in reserve markets, and trying to stop a little bit above what we consider ample. And we think we're meaningfully above that now. We can't put a number on it because you can't directly know the demand for reserves other than by observing behavior in the market and then putting a little bit of a buffer on it. So I can't give you an exact number, but for now it's ongoing, and we have a ways to go.
What kind of conditions would have to happen for you to start going back to quantitative easing?
So go to quantitative easing. That's a tool we tend to use when we're at the effective lower bound and we can't cut interest rates anymore. So nothing like what you're seeing in the current day. It's a different test for stopping quantitative tightening, but we would use QE going forward only in a situation where rates are at zero, and we're a long way from zero now.
So that you think that, again, just generally speaking, then, if things were to remain stable, you'll continue to unwind the balance sheet, you'll continue the quantitative tightening. Can't give me a range on this. Is that what I hear you saying?
That's right. That's right.
Okay, great. Well, I encourage you to keep doing that, because again, I think that's important to be able to make sure that you've got powder for the next issue that we may face. So thank you very much, Mr. Chairman. Appreciate you being here.
Senator Warner.
Thank you, Mr. Chairman. Chairman Powell, good to see you. One of the things we've talked about in the past, and I got 2 or 3 issues I want to get through fairly quickly, is that that while our regulatory framework should always promote financial innovation, that innovation can't come at the expense of things like anti-money laundering, consumer protection, financial stability. I continue to worry in many of these hearings where we keep seeing this regulatory creep outside the boundaries of traditional financial regulation. I think if we're starting a system from scratch, few of us would design it this way. But it is one of the reasons why I'm looking forward to working with Chair Scott and my colleague, Senator Lummis, on a framework at looking at stable coins in particular within the regulatory perimeter. I know my friend Bill Haggerty just introduced a bill in this area. I'm looking at trying to make sure we get those guardrails put in place, and how it touches the Fed is something that's terribly important to me. I know you and I have talked in the past about the notional idea of same activity, same regulation in the non-bank sector. If you'd like to wax briefly on this question around stable coins and how we think about them in the same point of, if they are similar to other activities, should they not have the same regulatory structure?
So we definitely support these efforts to create a regulatory framework around stablecoins. Stablecoins may have a big future with consumers and businesses. We can't know that now, but it is important for the development of stablecoins in a safe and sound manner, and a manner that protects consumers and savers and all, that there be a regulatory framework. So we see these bills and we're in contact as we were in the last Congress, and trying to add our technical thoughts and how to do this. And we think it's a very constructive exercise.
Well, we do think, you have a lot of expertise in this session, and there are people people come with lots of opinions on everything in crypto, from over the top to the other end of the spectrum. And I'm going to need to rely on your expertise as well as we try to work through some framework for stable coins. I know there are a lot of earlier questions on CFPB. I think the record is pretty darn good. It's returned $20 billion to consumers. Matter of fact, the last time we had the previous chair here, Chair Rohit, Ms. Chopra, we were talking about $55 million to Virginians. I do have to mention this more for my colleagues. Tim Kaine and I did a teletown hall last night. Lots of things happening in Virginia. Normally we would get maybe 3,000, 5,000, 6,000 folks on a teletown hall. We had 60,000 last night. I have not seen anything like that in my time up on here on the Hill, and a huge amount of concern about what the Doge boys are doing, whether our information is safe, whether privacy is protected. I had one lady say, in light of what was happening at CFPB, and while there's not a direct connection, she's saying, is her deposits at her bank safe? We tried to give her a assurance, but I said, you know what, ma'am, I'm going to be talking to the chairman of the Federal Reserve tomorrow. And with this diminution or shuttering, at least at the time being, of the CFPB, can I tell, I believe her name was Mary, can I tell Mary from Virginia that her bank account is safe?
I think bank accounts overall across the economy are safe. Yes, we've still got deposit insurance at the FDIC, and the banking system is well capitalized and safe.
Well, again, I think the concern was being raised was that the diminution of consumer protections lent her concerns about whether that dollar being safe. Last thing I want to recognize is that there's been reports in the media about the thinness in the treasury markets, the number of additional bonding that we're going to have to do, particularly with so many of these unpaid tax cuts. Matter of fact, one of the things that was really striking to me was that yesterday the president mentioned how he was, quote, examining treasury debt payments for possible fraud and suggested that our debt might not be as high as possible. You know, we all understand the full faith and credit of the United States is based upon a reputation. If this president were to suddenly say, I'm wiping off X amount of debt because I don't believe we owe it, what kind of effect would that have on both stability of the dollar and the overstability of our economy?
It will probably not surprise you that I will defer to you on that question.
So you think it would be, from a Fed standpoint, the President of the United States starts to saying we're not going to pay our Treasury debt. You're going to have no view at all?
I'm not going to comment on things that the president says.
I would like to see us at some point get a stronger answer on that, because I think that in light of the president's willingness to shut down agencies willy-nilly, his ability to potentially curtail payment of debt, I think would have devastating consequences on our economy. Thank you, Mr. Chairman.
Senator Britt.
Thank you, Mr. Chairman. Obviously, there's been a lot of conversation both in and out of this hearing room today. Conversations about a co-president referencing Elon Musk, referencing the work that Doge is doing. I think it's important to remember that President Trump ran on this. I mean, he said, we're going to look for wasteful spending across our government. We're $36 trillion in debt, y'all. That's not only fiscally irresponsible, it is actually morally irresponsible. And the difference in this administration and the last administration is that President Trump is actually the final arbiter. And it's interesting that none of you had anything to say over the last 4 years when it is clear that our commander-in-chief was not in command. And if we're going to use the term co-president, then let's go back and say co-president Jake Sullivan, co-president Ron Klain, co-president Jill Biden. I mean, it seems that some of the biggest decisions were made during the president's afternoon nap time. And so I just think we need to be a little bit more honest about what's been laid out and what's actually occurring. Chair Powell, I want to discuss some monetary policy issues, but I first want to highlight a few supervisory items. We unfortunately started 2023 with several bank failures in which the Fed itself admits its supervisors were, quote, too slow to ask. The question has been asked earlier about who was fired, who was not. I think that there's some real merit to having accountability that we have not seen there. In the aftermath of those failures, the Fed was certainly not slow to act when it came to new regulations, like the new capital requirements that would have put the U.S. banks at a global disadvantage and actually hurt consumers in my state. The way I look at this is the world came up with a gold standard. And then Vice Chair Barr said, hold my beer. And unfortunately, that hurts Alabamians. In addition to that, we had Community Reinvestment Act and stress testing frameworks that were basically adopted in secret. Or as we discussed last week, the reputational risk and just the arbitrary nature of that and those standards that were used to push political agendas. None of this is acceptable, and we've got to take a look at how to promote greater accountability and transparency into the Fed's supervisory function. Shifting gears, as of January 30th, the Federal Reserve had a mark-to-market loss on its balance sheet of roughly $221 billion. In fact, I looked back and the Fed has posted losses since September of 2022. Meanwhile, we've seen transfers to the CFPB totaling $2 billion since September of 2022. So just to clarify, Chair Powell, these money transfers are requested by the CFPB director each quarter and then directly deposited by the Fed. Is that how that works?
So the director of the CFPB requests money, and we, under the law, we send that money. Yes.
So, in fact, but Dodd-Frank actually prohibits the Fed from actually reviewing or amending those requests.
That is correct.
And so it gives full discretion to the CFPB
up
director.
to, I think, 12% of our, there's a ceiling on that, but that's correct.
So just to level set, how many times, has the CFPB funding request been denied by the Fed?
We don't have the authority
Zero.
to deny it under the law.
Zero, right?
Zero, yeah.
Yeah, that's what I thought. And by the way, I'd like to applaud the current administration and acting director vote for inserting some accountability back into the agency by pausing these quarterly just blank checks. on that, I know there's been a lot of conversation around the Bureau over the last few days, but I do want to focus on those last couple of years, particularly the $2 billion the CFPB received from September 2022 up to the last receipt on January 2nd, 2025. Congress specified in statute that the Fed shall fund the CFPB through the combined earnings of the Federal Reserve System. However, as I mentioned, the Fed has no current earnings. It has a balance sheet of negative $200 billion. So instead of the recent audit statement saying the Fed is funding the CFPB through assessments on its reserve banks, Mr. Chair, there are only two statutes that authorize the Fed to make reserve bank assessments, and neither permit the CFPB to fund transfers. So what authority exactly did the Federal Reserve have to assess the reserve banks in this manner over the last 2 years? I just wanted kind of a fact finding.
We looked at that question very carefully, and it's very clear on the law and the legislative history that we're still required to make those payments to do so.
Appreciate it. Thank you.
Senator Van Hollen.
Thank you, Mr. Chairman. I would point out that candidate Trump did not run on implementing Project 2025. In fact, when he was asked on the campaign trail about Project 2025, he said, "I don't know anything about that. Who are those people?" And yet he early on and quickly installed a key architect of Project 2025, Russ Vought, as the head of the Office of Management and Budget, which we know is the command and control center for the budget overseeing all federal agencies. And that's what Elon Musk is doing now. He's implementing Project 2025, the same Project 2025 that candidate Trump said he knew nothing about. And he said that because he knew it was unpopular. He knew it would be unpopular to take the financial cop off the beat. And I want to start by talking about what's happening over at CFPB, the Consumer Financial Protection Bureau, because that is the cop on the beat to go after fraudsters and scammers who cheat Americans out of their hard-earned money. And they have returned billions of dollars to our constituents, to the consumers who have been victims of these scams. And in doing so, they've earned some powerful enemies who want to shut them down. And Elon Musk is doing that dirty work on behalf of those fraudsters. And there's something especially twisted about the richest man in the world shutting down an agency that helps victims of scammers and fraudsters recover just a little bit of their hard-earned money. And I find it especially interesting that the new self-declared head of the CFPB, Russell Vought, told employees not to come into the office and essentially to stop work. Here's what he wrote, and I'm quoting, "Employees should not come into the office," unquote, and stand down from performing any work task, unquote. So this is an interesting situation. Federal employees continue to get paid, but the Trump administration tells them to stop doing their work. That apparently is what the Trump administration thinks is a good deal for the American taxpayer, to pay employees to not to do their job. So, Mr. Chairman, I have a simple question for you. Is that a practice that you pursue at the Fed, to pay your employees but tell them not to come to work? Have you done that?
No.
That wouldn't be very efficient, would it?
No.
No, it wouldn't. And yet that's what the so-called Doge boys, efficiency boys, are doing. In addition to that, they're rummaging through the private, very personal, sensitive information of Americans at the Department of Treasury. So it seems to me that the Trump administration and Elon Musk are focused on everything except what Donald Trump said he was going to focus on during the campaign, which was to bring prices down. And when you look at the price of eggs these days, I noticed that Waffle House just instituted a new 50-cent per egg surcharge due to the nationwide rise in the cost of eggs. They said that's going to be a new surcharge, and other restaurants are following suit. You've seen that, right, Mr. Chairman?
Yes.
Yeah. And at the same time, the Trump administration has restricted federal agencies from providing the public with information about the bird flu, avian flu, which is part of the cost of egg increases. So what we're really facing here is an administration that campaigned on bringing down prices and is not doing that, did not campaign on Project 2025, and that's what they're doing. But when it comes to prices, Mr. Chairman, the president's also talking about significant increases in tariffs. Our Republican colleagues are also talking about passing a tax bill that gives weight disproportionately to the super wealthy and which will add trillions to the deficit by their own account. They're talking about playing around with the baseline. So my question to you is simple. All things being equal, do big increases in tariffs and increasing the deficit and debt put upward pressure on inflation? Isn't that simple math?
You know, it really does remain to be seen what tariff policies will be implemented, and I just think it would be unwise to speculate when we really don't know. I mean, we see proposals, but it's so hard to say what's going to happen. And
Well, last time the Trump administration was in office, the Fed took actions because they were concerned about the impact of increasing tariffs. Isn't that the case?
we wound up cutting rates in 2000 and I guess it was 19, but it really was because growth slowed and confidence was weak and the global economy was weakening. So the net effect of all that's what we look at. And it's really not just tariffs. It's tariffs, immigration, fiscal policy, and regulatory policy. And those will all go into a mix, and we'll try to make sense of it and do what's right for monetary policy.
If you could just get back to me, I'm not on the question of increasing the deficit by trillions of dollars and what impact you believe that has on inflation and prices. Thank you, Mr. Chairman.
Yes, sir. Senator Lummis.
Thank you, Mr. Chairman, and thanks, Chairman Powell, for being with us today. I think you're aware of what direction my questions will take. They will be focused on the bank supervision function of the Fed. And I'd point out that when you and I were toddlers, 1956, the chairman of the Fed at the time, William McChesney Martin, said that the Federal Reserve Board is an agency of the Congress. Ben Bernanke said something similar in 2013 when he told Janet Yellen that, quote, Congress is our boss. Do you agree with that statement?
Yes, the way I always say it is that our supervision, our accountability runs through the legislative branch, not through the executive branch, as it does in many other forms of government.
Thank you for that, because I wouldn't have guessed that that was going to be your response. The way that the Fed has behaved for the last 4 years in its relationship with the U.S. Congress is to thumb its nose at Congress. Your staff has repeatedly stymied information requests from this committee, notably made by myself, the chairman, the ranking member, Senator Tillis, former Senator Pat Toomey, and others. In my experience, the Fed is a black hole. It consumes information, but it never releases it. Your fellow governors have personally misled me on at least 2 occasions with respect to Wyoming and digital assets. And in recent federal court filings, former Senator Pat Toomey has accused your staff of lying to him while providing technical assistance on legislation that passed in the National Defense Authorization Act in 2022. Now, I have behind me a statement by the Fed's General Counsel, one of the staff that's sitting behind you today, who said, quote, the Fed generally resists legislative prescriptions. Now, to me, that's thumbing his nose at Congress, the very people that you and I just agreed you are responsible to and the people depend on. So this is why the American people think there's a deep state. This is why they think there are faceless bureaucrats making policy to hurt the very people of this country. Just look at the mess the Fed made of Silicon Valley Bank. And I contend that there is a lack of understanding that is deliberate on the part of the Fed with respect to digital asset policy. So the Constitution says Congress is your boss, but somehow your staff have not gotten that message. So, Chairman Powell, do you commit on behalf of yourself and the Federal Reserve staff to comply fully with all document demands issued by this committee in a timely manner?
Sure.
Will you instruct your staff to be complete in their responses and not to obstruct the oversight functions of this committee?
You know, we always work with the committee to be responsive to your requests. Sometimes they're beyond our capacity to respond to, and we work with committee and with committee staff to do that. But we're always responsive to committee requests.
And I'll look forward to engaging with you when you feel that our requests are outside of the scope of the oversight that we have over the Fed. Do you commit to disciplining or removing any staff that are found to have engaged in debanking activity, furthering Operation Choke Point 2.0, or other misconduct?
I can't make an open-ended commitment to remove anybody, but I will tell you that I am struck, and my colleagues and I are struck by the growing number of cases of what appears to be debanking, and we're determined to take a fresh look at that. In fact, I took the thing that you showed during the debanking hearing. When I saw that, we're now taking that out of the manual. So I thank you for that.
Thank you, Mr. Chairman. My time's up.
Senator Smith.
Thank you, Mr. Chair and Ranking Member, and thank you, Chair Powell, for being with us today. I appreciate your presence here. I'd like to start with the issue of the rising cost of home ownership, something that I know is of great interest to many of my colleagues on this committee. I know, Mr. Chair, that you care a lot about home ownership and making home ownership accessible and available to folks. My colleague, Senator Lummis, as well, many of the folks on my side of the aisle as well. And so I think this is something that we can agree on, that the rising cost of home ownership is a big challenge for our constituents, for Americans. And one of the big pressures, there are many, but one of the big pressures is the rising cost of home insurance. In Minnesota, families, seniors are struggling to manage a nearly 40% increase in home insurance rates. We've seen this over the last 7 years or so. And I know, Chair Powell, that you've told this committee in the past that that rising cost of buying insurance for your home has been a source of inflation as we've been trying to manage inflation. Now, I don't know anyone who doesn't see this crisis of rising insurance rates as being caused by extreme weather events. We've seen massive flooding in southeastern United States. We've seen flooding in Minnesota. We've seen fires in the Mountain West in California. I mean, these are climate-related events. That's not a political position. That is just a fact. So, we've got banks that of course, require, understandably, that a homeowner provide insurance as a predicate for getting a mortgage. So there's a big question about what's going to happen when insurance becomes unaffordable, or in some parts of the country, just literally not available, and what impact that would have on the mortgage markets, on the value of American homes. Just last week, a new analysis from First Street showed that overall, the value of U.S. real estate could be reduced by $1.4 trillion, colleagues, over the next 30 years due to unaccounted for climate risk. That's the cost, the risk of not being able to afford home insurance because of these extreme weather events. And the prospect of trillions of dollars of property become uninsurable is clearly a recipe, it seems to me, for market instability, both in the rental as well as the mortgage market. So my question, Chair Powell, is given these trends, how do you think the Fed and how do you think we should be thinking about the challenges that these events are going to pose to insurance markets and to the overall financial stability of the economy? I'm asking you to comment specifically on climate change, because I understand my colleagues on the other side of the aisle see that as a political question. It's more like what you see as the risk to financial stability here.
So let me quickly note that we don't regulate or supervise insurance companies for the most part, but we're seeing the same thing, which is both banks and insurance companies are pulling out of areas, coastal areas and things like that, or areas where there are a lot of fires. So what that is going to mean is that, if you fast forward 10 or 15 years, there are going to be regions of the country where you can't get a mortgage. There won't be ATMs. There won't, the banks won't have branches and things like that.
Right.
That's a possibility coming up down the road. It's not that the banks will stay there and keep making loans in the face of evidence of disaster, or that insurance companies will do right policies. They can cancel those policies every year.
Right.
So I think the risk is that they just won't be there and that people won't be able to get them. That's really the issue.
And it seems to me that that would be a massive source of instability in our economy overall. If you were to see that kind of dramatic decline in home ownership, home values, not to mention the disruption that would occur if people literally couldn't be in their homes anymore.
So I think it's going to fall. If that happens, it'll fall on homeowners and
Right.
residents, but it'll also fall on state and local governments, which you see happening now, where they're stepping in states where insurance is going away. Private insurance, you're seeing states step in because they want those areas to remain prosperous. So I don't know that it's a financial stability issue, but it certainly will have significant economic consequences.
Well, certainly to try to figure out how to provide reinsurance.
Sorry, guys, I was on mute. Yeah, somebody said in the audience, they're just rotating the same questions over and over: housing, regulation, all that stuff, but nothing too pressing about interest rates or inflation. Market's not really moving too much off of this. There was not a huge amount of market response here. Gold, however, kind of back to break even on the day. Gold and silver both rising during that period. Nothing super dramatic. Stocks also rising, but this was before. You can see kind of the move in gold and silver was before and after the event started. So here's Nasdaq. I mean, big pop here on the day. Nothing too market moving so far in terms of headlines. Remember that Powell is testifying today and he's testifying tomorrow as well. Also, in case you did not already do it, if you have not joined the Telegram channel, it is completely free to join. We share market analysis each and every day. We have bonus clips. If you're a fan of the channel, we're posting bonus clips in there as well. We also offered some trials on the Edge Finder here today. So if you're not already in the Telegram channel, we'll also be doing a huge giveaway tomorrow. So don't miss the opportunity to join the giveaway. If you would like to enter for a chance, make sure to join the Telegram channel, linked right there in the chat, as well as in the description down below. Okay, guys, that's going to wrap it up for me. I'm going to move on. Got some other stuff I got to get to today. If I make any updates to the silver position, I will, of course, update that in our VIP Discord, and stay tuned on that. Okay, guys, everybody, thank you very much for tuning in. Have a great rest of your day. We'll see you next time.
Thanks for watching today's A1 Trading Show. Be sure to subscribe and to turn on notifications so you don't miss the next one. Want more from A1 Trading? Check out the links in the description below or our website a1trading.com. We have lots of free trading tools and channels available for you. We hope you have a great rest of your day, and we'll see you tomorrow.